Fed Chair Jay Powell testifying before lawmakers this week, where he addressed core concerns about the state of the U.S. economy. Well, one major issue for the central bank is, of course, inflation, which has yet to fall, and it's a far cry from the 2% target.
Headline inflation has come down by essentially half, but that's largely due to energy prices coming down and commodity prices that go into food coming down. And those are not, I won't say that they're not affected at all by monetary policy, but they're principally affected by other things in the economy. Really, where monetary policy takes effect is in the service sector, and that's where we haven't seen much progress. But we are seeing progress in other places, as you point out. Inflation broadly is coming down, but as I said in my remarks, we still have a long way to go.
All right, well, joining us now is Jeanna, Smialek, a New York Times Federal Reserve and economy reporter, also author of Limitless, the Federal Reserve takes on a new age of crisis. Jeanna, it's great to see you. So let's just start with what Powell was just saying when it comes to inflation, the fact that it is much stickier than what the Fed had anticipated it would be, which much stickier than what many forecasters had anticipated it would be. Can we jump to any conclusions just about the progress that we have made on inflation, what that could then tell us about the pathway forward, or is that going to look very different potentially?
It could look potentially quite different from what we've seen so far. So we have seen a lot of disinflation on sort of that headline basis. So when you look at overall price increases, they are down from a peak of 9% last summer to about 4% now. So that feels really good. But unfortunately, the remainder of getting inflation from that 4% to the 2% goal could be a real challenge. You know, we are in a situation where we have relatively rapid service price increases, and those can be much stickier. And that's what we're seeing really around the globe right now. We're seeing rapid service price increases in England, in Europe, here, really across advanced economies. This problem's pretty shared. And so I think from the Fed's perspective, that's a reason for concern. You know, they're worried that this is going to be a harder fight from here on out.
So then which aspects of inflation in the economy can the Fed take credit for versus luck from some of these outside factors, things like regional banking, or, you know, also contributing, and macro conditions as well?
Yeah, absolutely. So I think that it's a pretty big portion so far has been either luck or something that we expected. So we saw a lot of healing in supply chains after sort of a very tough period for supply chains right after the pandemic. And that's helped to bring down goods prices. We've also seen gas prices actually fall outright compared to where they were last summer, which is really about the war in Ukraine and some of those supply issues. And we've seen commodity prices really come down, which matters for food prices. So at the grocery aisle, things are a little bit less painful than they were before. All of that is great news for consumers, but not necessarily something that the Fed has directly caused. Interest rates don't really affect egg prices. That's more about, you know, the avian flu and its trajectory. And so that's really where we are right now, is there are good things happening. There's a lot to be happy about. It's not totally clear that it's all Fed policy at this stage.
So, Jeanna, I want to ask you, this is Diane speaking now. I know you're talking to like three ladies right now. She's like, who's talking? Great to chat with you again. So you did a deep dive into the impact of inflation, not just kind of the highbrow level of where it stands, what the Fed has done, and the overall impact, which we will continue to see play out, because obviously it takes time from the actual move to see how it actually impacts inflation. So let's talk about households. Are people really comfortable? It seems like Fed Chair Jerome Powell is not comfortable with the level of where inflation is, but are people comfortable with where it is?
You know, it's interesting. I've talked to a lot of people over the last couple of weeks just for various stories I've been working on about their inflation experience recently. And one thing you will consistently hear is that people are feeling a lot better about inflation in light of how much gas prices have come down. You know, I think for a lot of people, even though gas prices are really this sort of idiosyncratic part of inflation, you know, they move around for a lot of one-off reasons that policy can't do much about. I think they are very salient to a lot of people. And so that has mattered. I would say that when I talk to people and they're still feeling bad about inflation, it is often the case that that traces back to food inflation. Either they eat out a lot and sort of away from home food, restaurant meals, fast casual meals, those have all remained very rapidly increasing in price. Or it will be the case that they've just seen their grocery bill go up so much in a relatively short period of time, and it isn't coming back down. When we talk about disinflation in groceries, we're not talking about deflation. Like, grocery prices aren't climbing as quickly, but they are still climbing. And so that makes some people feel very bad. So I think it's a bit of a mixed bag from a consumer perspective.
Jeanna, what about the messaging from the Fed and how the market is interpreting this? Because it's happened time and time again, and we just saw it even within the last week or so at Fed Chair Jay Powell coming out saying that 2 more hikes will likely or could potentially be necessary in order to get a better handle on inflation. Yet the market wants to discount that. The market is trying its best to ignore it. Why do you think that is?
I think this is such a complicated time to be a Fed watcher, because what the Fed has said here is we think we're going to do 2 more rate increases if the economy proceeds basically as we expect. And that, as we expect, they kind of gave us the rough contours of what that looks like. It looks like pretty rapid growth, not super fast, but better than last year. It looks like very low unemployment and just kind of generally more of the same of what we've been seeing recently. Now, I think for economists and market watchers and investors across Wall Street, what they're saying is there's some solid chance that actually the economy deteriorates. Actually, that sort of steady sort of forecast that the Fed has laid out does not materialize. And I think that is why markets don't believe the Fed, that they are actually going to make these 2 rate increases. I think it's less that they don't think that they would if they felt that it was necessary, and more that they don't think it's going to be necessary. They think the economy is going to slow down. They're really looking at the recent tick up in jobless claims and saying, hey, the job market's about to crack. We just haven't seen it yet, but it's coming. And so I think that's where that disconnect is coming from, especially, when I talk to sort of investors who are very Fed focused. That's kind of the narrative that they're telling me. And a lot of Wall Street analysts actually agree with investors. They are not betting on a higher Fed interest rates this year. And so, I guess we'll see how it shakes out.
And obviously, when you think of the things that people prioritize, you mentioned obviously gas, groceries, but you also have a roof over your head, but you also have wages. I mean, we're seeing some of these companies continuing to pass on some of the costs of having to pay these higher wages. Consumers are still spending, though. And so it seems like this cycle that we don't seem to be able to break. What do you think is actually going to end up breaking it?
Yeah, so theoretically, when this happens, this is exactly where Fed policy works. It's an unpleasant thing to say, but I think it's the reality, is that the Fed basically slows down the economy by cooling off the labor market and making sure that we aren't earning as big of wage increases. And as we earn slower wage increases, we pull back on our spending and demand pulls back, and you get that sort of, cascading slowdown through the economy that eventually brings inflation in line. It's a painful process. The Fed's the first to say it's a painful process, but that's basically how interest rates work. And so I think the idea is that if the Fed has pushed the economy enough, if it's kind of gotten it to that pain point, we should start to see that pullback. We should start to see weaker wage growth, and that should translate into less demand and slower price increases. The challenge is that we do seem to be seeing some early slowing in wage growth, but it remains very rapid. It's been rapid for a while, and inflation is coming down, which means that for the first time in a few years, people are actually taking home real wage increases. Even after subtracting out inflation, you still are getting a wage increase. And so I think, it's sort of, tough along that dimension. It's been difficult to slow down an economy that has this much momentum enough to really sort of wrangle wage growth out.
And Jeanna, some critics say it's the Fed's fault we're even here in the first place, and kind of this catch-up mode, if you will. And, critics say we've done enough, just stop. Is that valid criticism?
It's an interesting question, and I think the Fed itself is asking that question. Have we done enough? Can we stop? The challenge with monetary policy, and this has, been the case for sort of time immemorial, is that it works with a really big lag, but we don't know how much that lag is. So what we know is that it takes somewhere between several months and several years for interest rates to fully affect the economy, which means that you don't want to be raising interest rates until you actually see the economy crack, because if you do that, you've probably gone too far. The flip side of that is the Fed does not want to err on the side of overcaution, not do enough to slow down the economy and allow inflation to just persist for year after year after year, because then it's going to become part of like everyday life. It's going to become part of human behavior. We're going to ask for bigger wage increases to cover the inflation. Companies are going to put up their prices more regularly. It's going to get really entrenched, that inflation, and then it's going to be even harder to stamp out. And so I think that's what the Fed's trying to do. It's trying to weigh those two challenges against each other right now.
Indeed. Remember, Powell did caution about he'd rather go too far than do too little and then be back in the same position all over again. We'll have to see how this plays out. Appreciate your breakdown today. Jeanna Smialek, their New York Times Federal Reserve and economy reporter. Have a great weekend.
Thank you.